How do public and private investments drive recovery from financial crises? In recent weeks, the conversation around financial recovery has intensified. With economies still grappling with the aftereffects of the COVID-19 pandemic, many are asking how investments can help. The question on everyone's mind is, how do public and private investments drive recovery from financial crises? Public and private investments play distinct yet interconnected roles in helping economies bounce back after financial downturns. When a financial crisis strikes, both types of investments are vital, but they operate in different ways and at different times. During a crisis, private investment often sees a sharp decline. Businesses typically cut back on spending for new projects due to decreased demand and rising uncertainty. For instance, private investment in the United States fell by nearly one-third since 2007, reflecting a significant slowdown in business activity. This drop can hinder recovery by leading to fewer jobs and less innovation. In these challenging times, public investment becomes crucial. Governments can step in to fill the void left by private investors. They do this by increasing spending on infrastructure, social programs, and direct support to businesses and households. Public investment helps maintain cash flow in the economy when private demand is weak. For example, during the COVID-19 crisis, the Federal Reserve and the United States government took extraordinary measures to provide credit and financial support. These actions were essential in preventing a deeper economic collapse and set the stage for recovery. Public investment also creates a stable environment that encourages private investment. When governments act decisively, they reduce uncertainty, giving businesses the confidence to invest again. This is particularly important during crises when private investors are reluctant to take risks. As the economy begins to recover, private investment typically starts to rise. Businesses identify new opportunities, expand operations, hire more workers, and invest in innovative projects. This shift is vital because private investment is often more efficient and responsive to market needs. However, if public investment remains too high for an extended period, it can lead to large deficits and debt. Therefore, once private demand recovers, it is essential for governments to adjust spending and tax policies to avoid long-term financial issues. On a global scale, foreign investment also contributes to recovery. Foreign investors often purchase government bonds or invest in companies, providing additional capital to support recovery efforts. For instance, European and other advanced economy investors have increased their holdings of United States bonds, aiding the U.S. economy during stressful times. In the realm of crisis management, balancing public and private investment is key. Public investment offers stability and support during tough times, while private investment drives growth and innovation once confidence returns. Together, these investments help economies recover and strengthen after financial crises.